I'm Brian Anderson, and this is Coast Connections. And with me today, if you're interested in finding out about your home mortgage or interest rates or things like that, I've got Nolan Smith, who's a mortgage broker. He's also with Mortgage Professionals Canada. And so that means you know everything about housing.
Not quite. I try though, as much as I can.
Okay. So what does a mortgage broker do?
We arrange mortgage financing. We act sort of as a conduit between people that need mortgage money and the lenders that can provide that mortgage money. So there's 50, 60, 70, maybe more lenders in this country. And we connect the dots there.
And the reason I wanted to just sort of provide a little bit of background, but I think really what you wanted to talk about today are some things that are going to affect the viewers to do with new mortgage rates or new mortgage rules, I guess, coming out.
Yeah, absolutely. The Office of the Superintendent of Financial Institutions, or OSFI for short, announced in October that they are going to be regulating the mortgage industry a little bit more come January 1st. So they're imposing a stress test, and they have a couple things around that, and it's surely going to affect the mortgage market and the home buyers market, especially in middle markets like Nanaimo.
So what do you mean stress test? Are we talking about, you pacing your heart?
Yeah. OSFI wants to make sure we're all healthy, and they want us to run regularly. No, actually, it's a funny term, but it's more an idea of stressing the interest rate market. So they're going to tack on 2%, a figurative 2% onto every mortgage qualification contract rate. So if you're approved for 3%, we as mortgage brokers and people in the banks have to pretend that your rate's 5%. That's going to inflate your payment on paper, and it's going to push up your overall qualifying scenario.
So it just means, like, for the threshold, I guess, to get into a house, you're going to have a higher income level to be able to support that artificial rate.
Yeah, that's right. So today, as of today, if you're picturing a house that you want, you can actually get approved for 20%, roughly 20% more mortgage money now than you will be able to in the new year if you're a conventional mortgage, which is 80% loan to value and less. This has nothing to do with the 5% down payment stuff. That mortgage market was hit last year in October 2016 with more regulations. This is focusing more on the called conventional mortgage market, 80% loan to value and less, so a 20% down payment or more. Also refinances and renewals.
So, and you say it's going to apply to renewals?
Yes. This is actually one of the biggest question marks and concerns around the whole thing, because right now, if you're offered a renewal from your lender, you can shop that. You can talk to maybe another bank or another mortgage advisor or professional about maybe trying to get a better rate. Okay. If you're into a renewal situation next year, and if you're with your current lender, you don't have to qualify for the new under the new stress test rules with your current lender. But if you want to move to a better rate product, okay, you have to go get approved. This is how we're interpreting the OSFI rules. You have to be approved under the stress test rules. So if that teeters you over your qualification, you're kind of stuck in the lender you're in, and it weakens your negotiating power for a better rate. And 47% of big bank mortgages next year are renewing within 1 year. So you can see 47% of the mortgages in the big banks are renewing within 2018.
You mean the volume that we did in 2017 was all short-term, because obviously the people could get the best rate to maximize the amount of the house that they were buying?
Yes, yeah. And by that stat, I mean that back in, let's say on a 5-year term, 2013, a lot of those mortgages are coming up for renewal. In fact, almost half the book of banks are renewing next year. So there's going to be a lot of people in their current mortgage right now, whether it's with TD or Scotiabank or CIBC, any of the big five, that might have problems in the new year finding a better, more competitive interest rate.
I've always been the really conservative type that wanted to know what the rate was, what the payment was. Always went 5 years, when a lot of people I knew were saying, oh, I'm going to go floating for 1 year. And So I've paid mega dollars over the years to have that comfort of knowing what your monthly payment's going to be.
That's an excellent point. Historically, variable rates have outperformed fixed rates. So people like yourself that want that security of that fixed payment generally pay a little bit higher. But I think that what's going to happen with these new regulations is it's going to force people maybe into shorter terms, 2 and 3 years, because they might be able to get qualified for that product rather than a 5-year with a higher rate plus 2%. So, it's going to push people into the variable rates, which isn't necessarily a bad thing. And it's going to push people into the 2 and 3 year rates, which actually creates a more volatile situation, because if you're having to renew your mortgage every 2 or 3 years, who knows what's going on in the rate market. Yeah. 5-year rates right now, if you're on a 25-year amortization, you're going to pay your principal down by 15%, and generally speaking, your income is going to be increasing by 10% over that 5-year term. So 5-year rates are safe. They're proven, but they are a little bit more expensive. But these changes are going to probably really promote shorter-term mortgages and variable rate mortgages.
So why are they doing this?
That's the big question. I mean, the government has been meddling in people's finances and with regards to mortgages really since 2008, 2009. And a lot of people will argue that that was incited by the big financial collapse in the States. Maybe it is, maybe it isn't. But, they've been really tightening the regulations over the last 8 years. And their official statement is, well, we need to protect we don't want people to have big increases in interest rates and now face higher payments and maybe possibly default on their mortgage loans. But the thing that's curious to me about that is only not even 0.25%, 0.24% mortgages are in arrears. So that means that 1 in 400 and something mortgages is actually defaulting right now. So it doesn't really add up to me that they say that's what they're trying to fix, and then they need to overinflate a hypothetical situation on a mortgage application.
Well, and they keep talking about credit card debt and the amount of debt that Canadians carry, but I think we're very good. We're better savers than the Americans. Not to slight Donald Trump and his gang, but I think the American market is a total different kettle of fish.
Excellent point. And it actually kind of irks me when I see people trying to make parallels between the American mortgage and debt market compared to ours. Everybody tries to write something online that's going to get a lot of views and shares, and they like to use fear tactics by saying, oh, geez, these parallels in the U.S. to Canadian market, and but that's one factor in 100. And the difference is that when that happened, the delinquency rates for missed payments over on debt was, I think, over 15% or 10 to 15%. Our delinquency rates, though our debt is piling up. I think we have like 90 billion in unsecured credit card debt right now in this country as a whole. But our delinquency rate is less than 0.1%, 0.2% is our delinquency rate. So we are gathering more debt, but we're paying our bills. So, I just don't understand really the correlation between trying to protect against default and a market that's not defaulting.
Okay, but I mean, the average person that's looking at buying a house, they don't even think about defaulting. What they're really trying to do is get as much house for their buck as they can. So are you suggesting that it's going to be tougher, or I think the number 20% increased income, they're going to need more income to be able to afford that house?
Yeah, that's right. And remember, this is just on conventional purchases. So, for the 80% loan to value and less, I think that I don't think it's going to be as big of an impact as people like to say. And again, I think there's more fear mongering going on. Posts and media outlets and all this stuff love talking about this. But, I did some data research on my mortgage book, and, we looked at the 100 mortgages we did this year, and 8 or 9 of them would have been affected by the stress test. And I foresee that the lender market might react and, let's say, extend amortizations. So that lowers your payment. So you might qualify for that. So that might save 1 or 2 deals. And then there's the private markets that we have access to, maybe save another couple. So I'm down to 5 to 6 mortgages that might be affected out of 100. And that's not a lot, in my opinion. And if everybody else's mortgage book is like mine, maybe that is extrapolated over our market, and maybe it won't be that big of a deal.
Yeah, it'd be much more impactful if you're only doing one mortgage a month. But
Yeah.
you might not be, like with Jimmy Pattison, you might be out the door if
That's right,
you couldn't
yeah.
produce the numbers. But.
The lowest performer gone, that kind of, yeah. Yeah.
So what about affordability? Because isn't this going to make housing more unaffordable for people?
I mean, on paper it will, yeah. I mean, technically, the numbers read that if you try and buy a house today and what you can get approved for, and then in January 2018, that's 20% less. So on paper, affordability, yes. But in reality, no. The payment's the same. You know, rates have been climbing up, you know, recently. They used to be in the mid to high 2s for a long time. Now they're in the low 3s, mid 3s. They're climbing up a bit, but they're not jumping 2%. So I just think on paper it will affect people, but in reality, I don't think it will.
I've been in banking for a while, and I can remember when interest rates were up at 18%. So I think I should be able to sell 8% really easily, but only to people that went through that. But it's funny, you can't.
You know, Brian's a good point. I hear it a lot. And but the difference is that even though the people you were dealing with had 18%, what was the average size of the debt on those loans?
Yeah, significantly lower.
Significantly lower. And we've had record gains, not only just in Nanaimo, and of course the Vancouver and Toronto markets are just ridiculous, but you know, middle markets like Nanaimo, we've had major gains, and that goes across the country. And so now you're seeing the cumulative national mortgage debt rise. And if I'm a part of policy in the government of Canada, and I'm looking at policy, what do we need to do? I will not spike rates higher and effectively increase people's mortgage payments, which will pull money out of the economy. And our GDP is already low. It's getting better. But if people don't have that liquid income or leftover income to go and buy a car or go on vacation, and you know, that's draining money from our economy. And I think that that's the most important thing in any economist's mind, is keep our economy increasing. You know, I don't think they're going to spike rates up to 3, 4, 5, 6%, because the implications of that is quite scary.
Well, when you say things like sort of trickle down, it's almost sounding Reaganomics.
I don't know what Reaganomics is. I've heard the term quite a bit. Maybe enlighten me. What exactly was Reaganomics?
Basically, government spending trickles down, and so, you know, $2 that you spend here becomes $5 down the road. Now, maybe that was flawed math, but but that was sort of Reagan's idea of where the economy was going, that if you're helping the markets, things would take care of themselves.
Yeah, absolutely. It's all correlated. And, you know, and coming back to OSFI's regulations, I mean, if they start stressing the real estate market, 7 out of the main 10 provinces in this country, their main economic driver is real estate. Now, not to say it's just mortgage professionals and real estate agents, but every mortgage deal needs a lawyer. Every real estate deal needs maybe an accountant, inspectors, appraisers. So the ripple effect of Reaganomics, I mean, talk about ripple effect in our industry. If they're stressing this market, and if there's problems in it, and they keep kind of over-regulating and hampering people's ability to buy, that doesn't just affect professionals and buyers, it affects a wider market, a more general economic effect.
And I know the provincial government brought in regulations to try and cool the Vancouver housing market by adding on a tax for foreign purchasers. Mm-hmm. And that didn't really have the impact that they thought it was going to have. People were projecting that the Vancouver market was going to, you know, hit a bubble.
Yeah. Or
the bubble was going to burst.
Yeah.
But we've seen a situation where there's very low inventory and housing prices still keep creeping up. The Vancouver market's crazy.
Yeah, it's an anomaly in Toronto too, and you know, it's just not like that all over the place. So when the federal government paints this one broad stroke over the entire market because of 2 hot markets, it's really unfair to the other middle markets that get affected. Yeah, you're right.
And Nanaimo, what do you see, maybe a bad question for you, but what do you see happening in the real estate market itself?
More gains. Honestly, I believe more gains. I think that you touched upon inventory. That's driving prices upwards. We're hitting record units. where the buyer's coming from, anybody can speculate on that. Alberta, people retiring and moving here, people getting outpriced in Victoria coming north, people getting outpriced in Vancouver and cashing out and coming this way. I mean, there's a lot of reasons why we're hitting record units. I just don't really see that stopping because of a 2% fake interest rate on a contract. I think we're still going to make gains. And think about, I believe we're really undervalued still. And I can remember my brother bought a house for $290,000 about 4 or 5 years ago. It was on Brandon, right near Brandon Lake, a ranch or 3-bedroom with a big yard and a detached shop. $290,000. I couldn't believe it. That house is now worth, of course, over 400, but our adjustment is happening now. I mean, markets all over the island have been making major increases over the last 10 years. Comox Valley and Campbell River, Victoria, of course, even Duncan. We're catching up now, but I don't think we've reached our potential. I think we're still going to keep climbing up.
I've been expecting the Nanaimo market to show some sort of cooling, but again, nothing's happened. It's just, and I think you're right, that it's part of that is low inventory levels. If you had an oversupply, then it becomes like a buyer's market, whereas right now it's more a seller's market because prices are higher.
That's right. And that hasn't changed in a long time. It's been like that, I mean, probably 2 to 3 years it's been a seller's market and it hasn't really cooled. There's been simmer points, but all of a sudden there's a spike, and you talk to any realtor that has a listing, they'll maybe get 1 or 2 showings 1 week on a house and they'll list another house and that'll get 10. And you got 1 offer on one house and 4 on another. And those competing offers are driving up home prices, because if my neighbor gets 5 offers on his house and people are competing with each other and he gets another $60,000 for his house, I think my house is worth what he sold it for. So that just dictates my mentality when I'm ready to sell, and the bar keeps increasing.
That's what I like to see when houses sell in my neighborhood. It makes mine look better. But,
that's true.
So that's good. But I think for young people, especially couples that are starting out, what's sort of the best advice as far as if they're looking at trying to get into housing?
Well, in the fall consumer report that Mortgage Professionals Canada did, I was pretty surprised by this. I didn't know this, but on average over the last few years, a first-time home buyer's down payment on average was 26%. And that's crazy to me, because, you know, I deal with a lot of first-time home buyers and we see them coming in at 5%. And a lot of it's coming from now parents. So, you know, they get the federal government trying to regulate the housing prices, and you have the provincial government that's introducing programs like the BC Home Partnership, where they're giving people interest-free money to buy homes. There's a disconnect there. Overall, I see a lot more first-time home buyers needing co-signers. So, you know, not necessarily, I mean, they're generally in the lower income bracket of their, let's say, work life, and they just need more income on the application to qualify, because now we're using fake interest rates that we're being imposed to use, which is inflating their payment and pushing what's called their debt ratio upwards. They're going over, so they need more income on the application, and that usually comes from mom or dad.
Yeah, because I think we're still faced with a situation where there are a lot of you know, baby boomers and my parents that, you know, a lot of that wealth is being passed on. So I guess you can pass on that wealth early by co-signing.
Yeah, absolutely. Or take out a loan on your own house to give to your son or daughter to buy a home. Yeah, absolutely.
So do you include that kind of a gift in calculations, or is it just?
Yeah, so, you know, anybody's allowed to, for a down payment, to use a gifted down payment, and you just have to sign a declaration saying that it's a gift and you're not going to give it back. So that is very common now. You see a lot of people with these increases in prices requires a higher down payment. You know, generally the overall cost of living is higher, so, you know, people in their 20s and 30s that are, you know, trying to make as much as they can in income, it's going a lot into the cost of living, not necessarily into a savings account to save up for a $400,000 or $500,000 purchase on a home. So, yeah, it's definitely leaning over into co-signers coming onto applications.
So do you sometimes feel that you have to rein in people's ambitions because they're maybe trying to take on more than they should?
Sometimes, yeah, sometimes. But here's the thing, like, all of these things that are happening, I mean, last year in October 2016, it was the high ratio market, the 5% down buyers that got this new stress test where they had to qualify at the Bank of Canada benchmark rate. So now, instead of using the real rate, which is 2.5, they got to pretend it's 4.9. So they've already kind of been pretty much like regulated into this stress test thinking. But it just doesn't change the reality of the situation. And a lot of first-time home buyers are looking for homes with suites, and suites have a rental income, and that rental income goes directly into your mortgage payment, or a lot of people plan that. So, and the reality is, you know, the payment that we have to qualify them at and what they really have, and there's two different things. So the reality of the situation is they can afford the house, you know, and there's already major regulation on debt ratio and percentages of rental income we can use that already have tightened up, you know, guidelines to get a mortgage. So I just think the reality is they can afford it, but it's stressing it as the values go up and up.
Now, you mentioned, like, this is a federal regulation. So there are a lot of organizations like Treasury Branch in Alberta or the credit unions in BC that are provincially legislated. So they're not necessarily tied to the same rules and regulations. Is that going to kind of skew the market?
That is the best point that you can make in this conversation, is what are the credit unions going to do? Because you're right, they're provincially regulated. FICOM is the governing body of mortgage brokers in this province, and the credit unions watch them for regulation, and FICOM's not doing this. It's a federal regulation, so they're at this point not following OSFI's guidelines. So that's going to translate to a massive influx of business into the credit unions, and credit unions lend out balance sheet money. That's deposits that they take from people, and they lend that out. So they only have so much money to lend out. They're going to do one of two things. So they're going to either cut down the amount of people that can come in and get a mortgage, or like a broker that has a relationship with them, they might stop a lot of people. In fact, they already are. They're cutting a lot of broker relationships where you can't submit to them anymore. So that's one. Second thing they're probably going to do, they're just going to eventually probably fold over into the OSFI guidelines, because I don't think that they can handle the amount of business that they might have coming down the pipe.
So one way to limit things would be for me to put you on call block?
Me on call block? You wouldn't be the first.
Okay, no, I'm teasing. But do you really think that the credit unions could become, in effect, that busy that they would have to limit things?
Well, I think so, because that's where you go. If somebody calls me for a mortgage and I'm doing the stress test and they don't qualify, I'm going to go down to contract rate, because I know a credit union will do that. And now I'm calling the credit union for this file that normally I wouldn't, because all mortgage professionals, we have our favorite lenders that we use, and the ones that are quick and efficient and have great rates. But if we can't qualify at those upon first glance, we're moving to the people where we can get the file approved. That's our job. So that's going to push all over to the credit union.
Okay, so do you sometimes think that part of the assessment for you is trying to find a good match for your clients and where you're actually helping them borrow the funds?
Yeah, absolutely. And because of all the regulation, it's changed the lending landscape, and now there's all these compartments that borrowers have to fit into, and beacon score cutoffs and credit score cutoffs and amount of trade lines you need and the stress tests, and all this stuff it's a very confusing rate market. So yes, the balance is to find the best rate, but in a lender that's going to do the file, get it approved quickly, because in most cases we have a subject removal period in our purchases where we have to get it done efficiently. So that's the balancing act. It's finding best rate, best product, somewhere where you can get approved.
And then of course the housing market being the way it is, even getting appraisals is a little bit more of a challenge.
Do you mean like as far as a pipeline, like getting timing? Yeah, absolutely. And we're seeing this calm down now, but spring market, you couldn't get an appraiser in less than 3 or 4 days to come by. And if you're working on a 10-day subject removal, and remember, everybody's mainly the business people, well, I should say, you know, the bankers and the mortgage brokers and lawyers are working just during business days. So 10 days on a contract is only 8 business days for us to operate in. So if we can't get an appraisal for 4 or 5 business days, then they have to write the report, which takes another 1 or 2. It stresses that as well.
So the realtors should be taking that into consideration, that if getting an approval becomes a challenge, they should be providing more time.
You would think they would, but you know what? They got a job to do, and it's to land the offer or the counteroffer for their client. And if that means a shorter subject removal to do so, that's what they have to do. Pressure comes down to people that work during business hours, that only have business hours to operate. But it's either get the deal done in that amount of time or not get it done at all. So it is harder, but I do understand it.
So you've been doing this for a few years, I take it?
Well, I've been a mortgage broker for close to 10, but I've had my own company now for the last year and a half.
And you're enjoying it?
Yeah, I think I am enjoying it. It's a lot more freedom when you get to kind of make decisions for your company, marketing-wise or relationship-wise or expansion-wise. It's really great. But I think the thing is the main difference I noticed between being just a mortgage broker and a business owner. These things matter to me way more because I'm looking at the bigger picture, and it bothers me when there's over-regulation that might affect people that really don't need to be affected. So, you know, there's a lot of points that could probably get into and start calling conspiracy theory, but I'm definitely not going to do that. I don't want to bore your viewers.
No, and I think you're right in that, you know, I think over-regulation in anything can be difficult. I mean, it used to be just a free market system, and hey, buyer beware, sort of, but you know, we can't necessarily take care of everybody, but I think sometimes we try to do too much as a government.
That's right. And you know, one of the most glaring things that happened last year in October 2016 was the federal government dropped a lot of new regulations without consulting the industry. People like Mortgage Professionals Canada, major monoline lenders, I think the banks were consulted, but I don't know about that. But I just think that without industry consultation, without getting your finger on the pulse of what's really happening, how can you just put a broad stroke across this nation and tell people what they have to and what they can and can't do? Okay, well, thank you, Nolan. It's been interesting. If anybody has any ideas for topics on Coast Connections, by all means, we'll have an email address on the screen. You can send in your ideas or contact us. So thank you again, Nolan, and we're done for tonight.